Okay, well, welcome everybody. We're going to get started here. We're just about a minute early, but I got a few housekeeping things to go through to make this a good experience on the webinar here, so we'll go ahead and get started with those. So, thank you very much for being here to 20 Habits of Wealthy Traders. It's a little bit different than other trading webinars out there. Most of them out there talk about technical analysis or their black box system or whatever. This is just things that I've learned over the years talking to really good traders. So I'm going to share with those with you tonight. But a couple of things here. So the best way to have a good webinar experience is to give all your bandwidth that you've got in your computer to the webinar program, GoToWebinar. So you can turn off your instant messaging, Skype, your quote or news systems, even your browser, your email, anything that uses the internet is going to suck away bandwidth, and you might have some audio that breaks up, and you don't want that. So try to turn off everything that uses the internet that you can. If for some reason the audio is bad, you can actually call in. And it sounded like somebody was doing that on the phone, and it was really weird that we could hear them talking, which is not supposed to happen. I'm not sure what happened there, but a little bug in the system. But if you do have bad audio and for some reason you can't hear it, you can listen on the telephone while you're watching the slides. And the way you do that is you click on your audio mode under Use Telephone. A phone number will come up. It's not a local number. It is long distance, so if you have a per-minute calling plan or something, it's not toll-free. Just keep that in mind. But it is an alternative. All right, the way you can ask your questions is to type them into the question box. It's just me tonight. There's no moderator, so I probably won't answer questions too much along the way, because then I have to stop and look at this question box here and try to figure out which ones to answer. So I will answer questions, though, and if you've got something burning that you've got to know along the way, or you've got some feedback or some ideas for me, feel free to type them in the question box, and I will get to them. Let's see. Next is, all right, 20 Habits of Wealthy Traders. So my name is Tim Borkvin. I'm the co-founder of a website called TraderInterviews.com. If you haven't heard of me before, I have Hubert and John to thank, and Rob to thank for sending you over to see my webinar tonight. What I've done over the past basically few years is go out and try to talk to as many traders as I can, really good traders, traders that are making a lot of money doing this, mostly full-time, but some of them are trading part-time because they're doctors or lawyers or in construction and have businesses and don't want to quit whatever they're doing, but they want to make money trading as well. And I wanted to really find out if I could find some commonality between everybody who's really making money doing this. Because as you know, I don't have to tell you, there are a million ways to do this. There are a million ways to trade. There are a lot of people out there teaching trading that aren't trading themselves. And I just wanted to find out. I've always felt, for me personally, that the best way to find out how to do something is to talk to somebody who's already doing it. And so a few years ago, I went on this quest to talk to good traders and really ask them poignant questions about what they do, like really detailed questions about the technical analysis they do, how much money they make, what their percentage return is, what kind of software they're using, all those things. And I did start to hear things that were repeated over and over again. And while every trader kind of had their own style and way of approaching the markets, they all started to say the same things about how they approach, or their kind of overall philosophy about how they trade and make money. And so I have 20 habits here. Actually, I have 30 habits for you tonight. I've got 10 bonus habits for you that I think you'll find interesting. Some of these are going to be obvious. Some of them, I hope, will, at least one or two or three of them, you'll say, wow, I hadn't really thought of it that way, and it'll click for you, and hopefully you can add some of these habits to your own trading. I try to stay away from the whole, set your stop loss kind of thing, because we all hear that every day, and I try to get stuff that is not so much spoken about, that is not something you hear somebody saying every single time they're talking about trading. So some of these will be unique, and if you get one or two of these here that make it sound or make it feel like you can add those to your own trading, then I think I've done my job. Now, that said, this is a work in progress. So some of the things that traders are saying to me, I'm still processing in my mind and really trying to figure out what they mean by that. So there are a couple in here. I always pick up number 17 when we get to number 17 that, I'll be honest with you, I'm not that great at describing. I'm pretty good at it, and I'm getting better at it, but I'm not the best trader in the world either, and so I'm still trying to wrap my head around some of these things. So if you've got feedback, you can let me know. This is being recorded, so you'll be able to get the recording about 3 or 4 hours after tonight's webinar. This one will only be about 40 minutes, and we'll answer some questions too. But that's how you'll get access to all the slides and everything. So let's just go ahead and get started with these first habits. All right. Wealthy traders are patient with winning trades and enormously impatient with losing trades. And this is straight out of the mouth of Dennis Gartman. And Dennis Gartman has his own website. He's on CNBC. And he's one of the first people that said this, and I said to myself, I've heard this a lot from really wealthy traders. Think about this. When we first started trading, and some of you may still be this way, I am still this way, I'm still fighting this sometimes, we're all very patient with our losers. We're going to let it go just a little bit longer. Maybe I'm going to move my stop away just a little bit and hope it comes back. And for my winners, oh man, as soon as it comes into a profit area, okay, I'm going to move my trailing stop up. I'm going to be really careful. I don't want this thing to turn into a loss. I've got a winner here. So why is that? Why are we patient with our losers and letting our winners, why are we patient with our losers and letting our winners just drive us crazy and be very impatient? Really wealthy traders have totally flip-flopped that. They have turned it on its head so that they are now very patient with their winners, and they're impatient with their losers. They don't give losers a chance to ruin their trading account. They don't give them a chance to go any further than the predetermined point. So first off, make sure you're patient with your winners. Give your winners time to make as much money as possible for you. If that means that after a certain amount of points you scale out of half your position so you feel comfortable, great. But always leave some there so that you can take advantage of the full move. Okay? Get as much of that move as possible. Winning trades are few and far enough between that we want to make sure that when they do come around, we milk those suckers for as much as we can. So flip that reasoning that you first started with on its head and do the opposite. That's what wealthy traders do. Number 2, wealthy traders realize that making money is more important than being right. We all want to be right in the market. We all want to feel like our trading decisions are well thought out, well researched, and we're right about the direction of the market. Wealthy traders don't care about being right. They'll flip-flop and go from long to short in 30 seconds, 10 seconds, 5 seconds. They don't care about that. They want to make money. If the market says that they're wrong all day and the first trade they try is wrong and they flip it around and make money with the opposite, that's okay. They don't care. As long as they're making money, they're not concerned with being right. So you've got to flip that attitude of approaching the markets on its head too. Don't worry about being correct in your bias. If you like to set a bias before the beginning of the trading day, I've talked to wealthy traders that if their bias is long for that day, they will not take any short trades. But the majority of traders who are making a lot of money do this will flip-flop in a heartbeat, because they don't care that they're right. They just want to make money. So if the market says you're wrong about your attitude, you need to flip-flop it, they'll do it because that's what's important to them. And it should be. Making money is the important part here. Wealthy traders look at technical analysis as a picture of where traders are lining up to buy and sell. This is one of those that kind of grew on me after I had talked to about the first 60 traders. Most of us look at a chart and we see the moving averages or we see the trend lines, and we see that as places that price is going to turn. That's the place where the bar is going to come down to, touch, maybe go through a little bit, but it's going to reverse. Okay, support and resistance, all that. Traders think in a little bit different way. They don't think of it like that. They think of it as that trend line is where traders are lining up. Their traders are lining up to buy or sell, and most of the time I'm going to line up on the other side because I know 95% of traders are wrong, on the retail side anyway. So when they see a chart, they see traders and they see orders, and that's where we all need to get. Okay, we need to see that the bottom of a trend line, yes, the price may turn there, but it's not because the trend line is there. It's because traders are anticipating that happening, and they put orders in that affect that change. So yes, in some sense, technical analysis is a self-fulfilling prophecy, but you have to understand that it's just people putting orders in. That's all it is. Price is the demand, supply and demand for that thing, at that price. That's all it is. So start thinking about technical analysis as a picture of where traders are lining up to buy and sell. Not so much that it's at a specific point that price is going to change. It may, but it's more like a zone. Traders don't see it as it has to hit this Fibonacci 618 line before it turns, and it's going to come down and touch it exactly. They see it as, okay, the 618 line is right there. There are probably traders right above it, right below it. In that zone, just above and below it, is probably where I'm going to look for something that may happen. That doesn't necessarily mean they're going to try to pick that top or bottom, but they know that that's an area that's of importance and needs to be monitored. Okay. Number 4. Before they enter any trade, they know exactly where they will exit for either a gain or a loss. This is not something they halfway do. They don't get into a trade and then decide where they think the profit target might be and where to put their stop loss. They know before they even get in where those two numbers are. So it's important that you understand how much profit you're looking for, and it should be based on something objective. It shouldn't just be based on, I want 2 points out of there. Well, if the average true range for that, whatever that is on that day, or average any day, is 1.5 points, why are you going to look for 2 points just because you arbitrarily set that? So it should be based on something very specific. Average true range, an area of support or resistance that you're looking at, something objective, not just a 1 or 2 point, like I always want to make a point. Okay, that's nice. The market doesn't care about that, though. The market's going to do what it's going to do. So they know exactly where their profit target is. They know where their stop loss is going to be. And I'll talk about stop loss in a little bit here. They know that they base it on something objective, too. It's not just, I'm only okay with this if I only get, if I only lose a quarter per share. That's what I'm good at. So I'm going to put my stop loss there. No, typically a wealthy trader will have a reason why the stop loss is there. Maybe it's that they only want to risk 2% of their account, and the stock price is $100, and they're buying 1,000 shares, so they set it at X. Okay, they set that number based on the math, and they go backwards from how much risk they want to take. So know both those numbers and know them before you get into any trade. All right, number 5. They approached trade number 5 with the exact same mindset they did on the 4 previous losing trades. So what does that mean? We've all been in that spot where we've had 4 trades that we've lost on. 4 trades in a row we've lost on. It's about lunchtime in New York. I'm here on the West Coast, and I'm thinking, man, okay, here's a signal. It's coming back down to my trend line, or it's coming back down to that Fibonacci number. I've blown it the last 4 trades. You know what? I'm just going to sit on the sidelines for trade number 5. Guess what happens, of course? Trade number 5 works out and wipes out all the losses that you had the previous 4 trades, and then makes you another, $1,500. It's maddening. But what I found is that the really wealthy traders put on trade number 5 with the same gusto and same enthusiasm that they did the first 4, even though they lost on those first 4. And it's not that they're just blindly putting on trades, but the market hasn't told them that anything has changed. It's just that the trades that they put on previously there haven't worked out. That's all it is. And statistically, some systems can go 5, 6, 7, 8 trades in a row. Now, some will say, if I have gone 5 trades in a row and I've lost for that day, for whatever reason, I'm not reading the market properly and I'm going to step out for the day. That's fine, and you probably should put some sort of barrier on there so you don't just keep making the same mistake, because maybe you think the market is not telling you anything different, but you're just not reading it properly. There's a whole bunch of psychological reasons why that could be happening. There's a whole bunch of reasons just in the market. Statistically, it could just be happening. You just might lose 5 in a row. That's statistically going to happen. So, but if nothing has changed in the market, if you're confident in your edge, if you're confident in your system of trading, put on trade number 5 with the same gusto and enthusiasm and confidence as the first 4, even if they lost, because that's what wealthy traders do. And you don't want to miss on that trade that does turn around and happen for you. All right, number 6. They use naked charts and focus on zones. All right, so what do I mean by naked charts? This next slide shows you pretty much my charts when I first started out trading. I've got arcs, I've got pitchforks, I've got rays, I can't even see the damn bars in there anymore. Excuse me, I just swore on a webinar. I'm not supposed to do that. All right, I cannot see my price bars in there. I can see the volume, that's okay. But at some point, we all go through this thing where we pack on all these indicators onto our charts so much so that we can barely see the price bars anymore. The one thing that matters, and we can't see it because there's so much garbage on the screen. And then eventually we start peeling it off. I want to peel off the arcs. I'm going to peel off the pitchforks. Or maybe I'll leave the pitchforks because they'll be working for me, and I take off everything else. And almost all the wealthy traders I talk to, if they use any indicators at all, it's maybe one, maybe, but they're looking at price and volume. That is it. Price pays, as a trader told me today that I talked to, and I've heard it before, but price is what matters. Certainly, if you have a technical analysis tool that you like to use it, but don't go overboard. You're going to get paralysis analysis. You're not going to be able to decide what to do, and you're going to get the pitchforks telling you that it's not time to trade, the Fibonacci saying it is time to trade. So if you can get confluence on a few of these things, great, but don't go overboard. Make sure you can see those price bars because that's really what matters. All right, number 7. They realized a long time ago that being uncomfortable trading is okay. We all want to get to the point where we feel like we're going to sit down at this chair and know exactly what we need to do to make money today, and you're going to feel great, and you're going to put your trades on, and it's just going to be like a regular job where it's a little nervous for the first couple of weeks, but then you get the hang of it, and you feel good, you start laughing with your coworkers, and everything's cool, and you're comfortable. That's never going to happen to you trading. The reason is because you're always going to be dealing with incomplete information, and that's not comfortable. It's not comfortable to make decisions in that spot. But the really wealthy traders acknowledge being uncomfortable, and they get comfortable being uncomfortable. That's really the best way I can say it. And I know it's kind of a contradiction in terms. It is a contradiction in terms, but they get to the point where they just acknowledge the uncomfortableness of it, acknowledge the fact that they're never going to have a complete picture of information, and they make the decision anyway. And part of the reason why I think I've had some decent success as a trader, and other guys that have a law enforcement background, if you go to my site at some point, you'll see that I used to be LAPD. I actually still am. I'm a reserve officer. I still go out and chase bad guys a couple times a month just for fun. But when you're a cop, you have a lot of times when you have to make a decision without complete information. You know, does that guy down the street who's pointing a gun at me, is it a BB gun or is it a real gun? And I can't wait until I see the muzzle flash and a bullet coming into me to understand that. So I have to make decisions based on incomplete information, and police officers have to do that all the time. And so I think that's part of the reason why I'm comfortable being uncomfortable in front of my trading screen too. And so you have to get to that point. So what I need you to do is go out and become police officers, and then you'll be better at it. Not really. But you have to get to that point where you're comfortable with that incomplete information and you're comfortable being uncomfortable. So that's one of the ones I'm not perfect at describing yet, but I'm getting there. I'm getting a little better at it. All right, number 8. The markets they trade fit their personality. They are a participant, not an onlooker. So you hear that a lot, I guess, that you need to find a market that fits your personality. But I have a little twist on that, and I think it's not really that so much as it is they get to the point where they feel like they are participating in the market, like they're almost in the trading pit with everybody else. And I think there's a point where you start to feel like that as an experienced trader. Newer traders, and I feel like I'm more like an onlooker, like I'm an outsider trying to get a couple of trades in that I can make money on. And the really wealthy traders will tell you that they don't feel like that. They don't feel like an onlooker who's kind of attempting to get in on the party. They feel like they're in the party. They are a participant in the market, and they're making money by making a market for themselves and for other traders. So you've got to find certainly a market that fits your personality. It's not really frenetic and moving quickly and you feel like you're overwhelmed with information. But you've got to get to the point where you actually feel like you're a participant on a team of people that are making a market in securities, and not just an onlooker trying to place trades that you're kind of guessing on. Okay? It's more of an attitude, I guess, but I think that comes from confidence in making good trades and getting to the point where you feel confident in your strategies enough that you feel like you're a participant and actually taking the other side of trades of people that aren't confident. All right, number 9. They stopped trying to pick tops and bottoms long ago and stopped losing money doing so. I was talking to a trader the other day, and he made a good point to me. He said, look at this chart. And you could pick up any average chart. Just pick any chart and start looking at it. How many times is it trending, and what percentage of the graphics on those charts are actually turns? And that's true. If you start drawing lines through every place where it turns, it's like 2% of that chart. The 98% of that chart is it going in a single direction. Even on like a 1-minute chart or a tick chart, you'll find that to be true. It turns a lot less than it does continue in the same direction. So why are we all trying to pick the tops and bottoms all the time? We're trying to pick the 2% of the chart. Let's go after the 98% of the chart. And so that made a lot of sense to me, and I started to hear wealthy traders talk like that. They are waiting for, they want to see something turn, see the confirmation that it is turning, and then they get in. We're all very worried about missing the move. We're all very worried about missing that turn and missing it before it happens. These guys want to see it actually happen and confirm and go that way before they even take a trade. They're looking at that 98% of the chart while we're all out there trying to get the 2% of the chart. So hopefully that makes sense. I'm not saying that markets trend all the time, but they go in the same direction for a lot longer than they turn, if that makes sense. And I think you'll look at any chart and you'll see that to be the case. So just go after the meat of the move. Wait for things to turn. Don't be so anxious. Be patient before you get in. The trades will always be there, and try to get that meat of the move. Let's go for the 98% like the guys who are making a ton of money doing this rather than trying to pick that 2% lottery. All right. Number 10, they stopped thinking about the market being cheap or expensive. This was new to me too. When I first heard this, it makes a lot of sense. Google is not expensive if it's going to be worth $5 5 minutes from now, $5 more 5 minutes from now. A 25-cent stock or 25-cent option is not cheap if it's going to be worth 10 cents 5 minutes from now. So they don't think of the market as being cheap or expensive. All they care about is somebody going to pay more or less for this 5 minutes from now, 10 minutes from now, an hour from now, tomorrow, depending on what your time frame is. So 25-cent options can be the most expensive thing around if they're not going to be worth 26 cents later, okay? And so let's all stop of thinking about Google as being an expensive stock, or Buffett's stock for that matter being expensive. If it's going to be worth more later, I'll buy it all day long. If it's a $10,000 stock and it's going to be worth $10,005, I'll try to leverage the crud out of that thing to get it, even though it's a $10,000 stock. Now that's an extreme example, but I think you get the idea of what I'm talking about. Things are not cheap or expensive. All they are is somebody's going to pay more or less for this 10 minutes from now, an hour from now. That's all you're concerned about, okay? So no more cheap or expensive, It's either it's worth more or less later. That's really all you want to be concerned with. That's all wealthy traders think about. All right. Number 11, they're willing to change sides, short to long, and vice versa when the market tells them to do so. So this is kind of going back to the first point where they don't care about being right. If the market is telling them different information, if something has turned and they've seen confirmation of that turn and it's going the way that they didn't anticipate, either after earnings or whatever it may be, they'll sell their long position and go short without even a thought about it. They don't get down on themselves for being wrong about their first decision. They want to make money. That's all they care about. So they're willing to switch sides very quickly, and so should all of us. Number 12. They trade aggressively when trading well and modestly when they are not. This is another one of Dennis Gartman's ones. He's always said, if you want to do well as a trader, you want to be a wealthy trader, do more of what's working and less of what's not. He will tell you that that is the secret to being a millionaire trader. And he's right. Why is it that we feel like we need to trade more size when we need to make up money because we have losses and trade less because we're hesitant about losing our gains? I've seen monster traders who trade millions of dollars. When they get into a trade that's working for them, they can ramp up size like I have never seen. They will take and just pound. They will go from 1,000 to 5,000 to 10,000 shares of something very quickly when they feel like they are on the right side of the market and it's working for them. And when they feel like it's not working, they will scale back to 100 shares. Now, I took this to an extreme. When I first started trading, I told myself I would rather lose on commissions than lose money to the market. So what I did was when I had 3 losing trades in a row, I could only trade 1 share, literally 1 share of a stock, until I had 2 trades in a row that went well. Now, that was my own personal thing that went on me, and I knew that I was going to get killed on commissions trading 1 share. But if I couldn't be right trading one share, what the heck am I going to do to trade 100 shares or 1,000 shares? So I said, all right, I'll lose the commissions basically. And even today, that's not much of a problem because the commissions are cheap. But let's say you're on E-Trade or Ameritrade, you're paying 10 bucks a trade, whatever it is. If you don't feel like you're reading the market right, trade one share and just consider that $10 a cheap educational tuition rather than losing $100 or $1,000 in the market. So that's what I would do, and that's how I got myself turned around. Yes, I knew I'd get killed on commissions, but when I wasn't trading well, I went down to one share, and if I made money 2 trades in a row, then I could up my size again. So that's kind of an overzealous way to do it, I think, but it worked for me. And once in a while, I'll still do that. I don't know if I'll go down to 100 shares. Maybe I'll go down to 10. But if I thought it would help me, I'd go down to 1 and just pay the commission as my tuition. Number 13. They realize the market will be open again tomorrow. We all are so afraid of losing trades. I know traders who they would rather lose on a trade than miss a big trade. Now, how much sense does that make? They would rather lose money in their trading account rather than miss a trade that would go well for them. That makes no sense whatsoever. I'll take a flat account over a losing account every day. Ask me 10 times, I'll tell you the same answer. So the trades will always be there. It's hard to feel like sometimes that you'll never have an opportunity to short a Netflix again. Like, I saw that. I was a member of the service, and when they changed it, I should have shorted that sucker and made so much money. Well, we're all going to get a chance to short a Netflix again. It may not be Netflix. It may not be NFLX, but it will be some symbol that we're going to get a chance to just short or go long on. So understand that the market will be open again tomorrow. Wealthy traders understand that. They don't beat themselves up when they miss a trade. They'll take flat over losing any time of day. All right. Number 14. This is one I kind of get pushback on this by email after almost every time I do a webinar, but they never add to a losing trade, ever. So I'm going to go out on a limb here and say you have to do this. Never add to a losing trade. Let's all repeat that. Never add to a losing trade, ever. There will never be an excuse you will ever give a wealthy trader that says that you were justified in adding to a losing position. Now, I've had traders email me 10 minutes after the webinar saying, I've got a martingale strategy that I double down on every losing trade, and it crushes. Well, good for you. One of these days, you're going to blow out your entire account and everything else, too, because that only works for so long. And if it's worked for you for more than a couple of times, you're going to get crushed at some point. Everybody does. So never add to a losing trade. I think if you just stick to that, you're like halfway there. You're halfway to becoming a wealthy trader if all you do is this one. And it's like the easiest one to do. And yet it's the hardest one to do. We all want to say, you know what, I know I'm right about this, going back to being right, right? Well, we're right. I know I'm right about this. There's no way this sucker is going to go any lower. So I'm going to add to double my position. Okay. Stop doing that. It hardly ever works out. And if it's worked out for you up to this point, you've been lucky. Consider your luck, bank that money, and never do it again. Number 15. Cash is the target, but they set goals for their trading that are anything but money. Now, there'll be people out there that will tell you that, it's not about the money. It's about trading your plan correctly. And they're right, but guess what? It is about the money. We're not here for video game fun when we play the markets. We're here to make money. Money is what pays the bills. Money is the goal. For almost all of us, money is the judge of success. But here's the problem with that. When you make money your sole judgment of success, it really clouds your decision making. Because we're also emotionally attached to money. And by the way, if somebody tells you to get rid of the emotion in trading, they're foolish because you can't. You're a human being. You will never get rid of your emotion. All you can do is acknowledge it and make a decision in spite of it. So they know that cash is the most important thing. The money in their trading account is the most important thing to them about trading. But when they use it as their goal, they make stupid decisions because money clouds their judgment. So what they do is they take something else and make that the goal, knowing that if they achieve that, the money will come. So for some people, it's, I followed my trading plan, I didn't add to a losing trade, and I knew my profit targets and my stop losses before every trade. And if I did that and I had 6 trades today, and I took small losses because I followed my rules, then I've had a good trading day. If you keep doing that, you will get that money. The money will come to you, but it may not come to you that day. But if you do it long enough and you're disciplined enough, the money will come. Just don't make it the #1 goal in your trading plan, in your journal, that I got to make $100 a day or I've got to make $500 a day, because you'll overtrade, you'll make decisions you wouldn't normally make if that wasn't the goal. Okay, so we're not saying let's fool people and say money is not important and the trading profits are not important. It is, but you got to find something else to make your daily goal so that you don't make hasty and emotional trading decisions. Number 16, they read trading books, but they read more crowd books. This was interesting to me. Certainly trading books are fine. I'm working on one right now. There's a trading book full of interviews. But I found that the really wealthy traders also read books about mobs, riots, strategy. And I put 3 of the books up here that I think are good starts for that. The Wisdom of Crowds is a no-brainer. You got to read that one. If you haven't read The Wisdom of Crowds, go get it on Amazon right now, because it's a great read and it'll help you understand that trading and the markets are just emotional riots. That's all they are. The Art of Strategy is another good one. It's about math theory and math games. Great book. It's a little more in-depth, a little more intellectual. You won't read it as quickly, but good one. And then Markets, Mobs, and Mayhem is another good standby one that will teach you about the wisdom of crowds. So get one. If I had to suggest one, I'd say go grab Wisdom of Crowds, because that's probably the best one, but you'll want to read more too. Because really all markets is panic and greed and fear, and that's really all it is. And so if you understand the human psychology and the reasoning behind why riots start and why mobs get out of control, like normal, working, good people are suddenly tipping over police cars, one of my favorites because as being a police officer, but you realize that there's a reasoning behind that. There's actually method behind that madness, and so understanding that is going to help you understand why XYZ stock goes in the toilet after beating earnings by 30 cents. Okay, one of the many reasons. Anyway, number 17. Oh, I dread number 17 because I am not good at this one, but I'm going to give it my all for you tonight. They provide liquidity to the markets while watching price and volume. What do I mean by this? I have no idea, but I'm going to try. Here's what I hear that wealthy traders telling me over and over again. They say, Tim, I don't trade like most people do, where I have a trading account and I'm trying to guess at buying or selling. I'm a market maker. I don't have the title of market maker, and I don't go into the floor to be a market maker, but that's what I do. I provide liquidity to other traders, and that's how I make money. So the best way I can explain this, and I'm going to try it in 2 different ways. The first one is, think of a hot toy at Christmas time. We just finished the holidays. If you're a parent, a regular trader, what you do is you go out and try to buy that toy for your kid. You go out and find it, and you go to 16 different stores, and you'll go on eBay, and you'll try to buy it for it so that you can have that toy underneath the tree at Christmas. The trader finds 3 or 4 of those toys and goes to eBay and sells them, makes a market in those toys. That's how they make money, and that's how wealthy traders think of themselves in the market. They don't think of themselves as going to buy or sell for themselves. They think of it as making a market in that thing that people want or don't want. I think I'm getting a little better. I mean, does that make sense? Hopefully it makes a little bit of sense. The other way to think of it is somebody said, all right, how about this? You're at the grocery store at night, and everybody is at checkout stand 7 with a gallon of milk, because milk's hot. Milk is the thing right now, and you know, milk is what everybody wants, and everybody's hot for milk. So instead of a trader going back to the back refrigerator at the back store and grabbing his own gallon of milk and getting in line with everybody else that's there to buy milk, he goes up, taps on the shoulder of the checker who's running the cash register and says, you know what, let me step in for a while and handle this for you. Go take a break. Go take your lunch. I'm gonna make a market milk for a while for you. That's how they see themselves. They see themselves as the checker at the grocery store, not the person in line buying. I know it's not great. I'm working on it, but that's the best way I can think of how wealthy traders think of themselves in the markets. They think of themselves as market makers, not really as traders. If you got better feedback from me on how I can explain that, or you understand that, let me know in the questions. We'll go over some of these at the end too. Or you can always email me, tim@traidorinterviews.com. Number 18. they have a way to gauge fear, greed, and speed of transactions. And one way is tick charts. So I always feel that I need to know what the pace of the market is. And the way that I do it is I put on tick charts. And John Carter, who a lot of you came from to me, he's our advocate of 612 tick charts, and that's what I use. Sometimes I'll use like a 300 tick chart. But the reason I use at least one tick chart on my screen is because I want to see more bars printed the faster the market goes. The more the market speeds up, it's visually a way for me to see that the market is getting a little speeding up. Something's going on. If you're just using 5 and 10-minute charts, that's fine, of course, have those. But it's going to print a bar every 5 minutes, every 10 minutes, regardless of how many transactions there are, how many ticks there are. It's just the speed is going to be the same all the time. So I always have at least one chart up there that I can see out of my corner line, wow, this thing's really starting to print a lot of bars. Something's going on. There's a market being made in this area of the market that I need to pay attention to. And I find that wealthy traders have a way to gauge that fear, that greed, and the speed of the market by having something. And I think the most common, the easiest way, the thing that's available on almost every platform is a tick chart. So whether it's 612 tick charts or 12, some Fibonacci number of tick charts, use something so that you can get a gauge of the pace of the market. Number 19. They practice reading the right side of the chart, not the left. The best traders I have talked to, they're not mind readers, but you'd almost think they are, because we can all see the head and shoulders after the fact. The beautiful head and shoulders that is beautifully printed from last year, we see it. Wow, man, if I had seen that thing happening while it was happening, I would have traded the heck out of that sucker. Well, that's the trick, isn't it? Is seeing it develop while it's happening. So we can all see those bull flags, we can all see those bear flags, we can all see those beautiful trend lines and the moving averages. The trick is to see it happening while it's happening. That's when you got to make the money, not after the fact. We can all see those patterns after. The wealthy traders of this world practice reading the right side of the chart. Now, I don't want to get too, touchy-feely with you, but I want you to start thinking about and picturing in your mind where that next bar is going to print. The right side of the chart is the important chart. The right side of the chart that hasn't printed yet is what you need to get good at almost predict, and I hate the word you use, predicting, because you're not predicting it as a trader, but you have to get a feel for where visually you see that market going. And so the best traders are almost ignoring the left side of the chart, and they're focusing on that right side that hasn't happened yet. And they're picturing in their mind, where is that next bar going to print based on what else I see going on in the market. So start practicing that, and I think you'll be surprised at how good you get about where that next bar opens up, whether it be a tick chart or a 5-minute or a 1-minute, whatever it may be. Number 20, every wealthy trader has an edge. And I said after this, I have 10 bonus ideas for you here, so we're not at the end just yet, but the 10 go pretty quickly. Every wealthy trader has an edge. If you can't tell me, and if I can't explain to my 13-year-old daughter what my edge in the market is, I don't have one. You have to be able to give your elevator pitch to somebody else who doesn't understand the markets or isn't a trader, and they better understand what your edge is. It better not be so, well, let me back up. There might be a few people out there that are quants that say, I've got an algorithm because I'm a computer science PhD that nobody can understand, that because I've got a direct line to the trading floor. Okay, there are those people out there, but for 99% of us, you've got to be able to explain what your edge is in the market. And it doesn't have to be crazy. It could be, if you think your edge is the 5-minute or the 5-period moving average crossing above the 10-period moving average, then that's your edge. I would say you're going to have to find something that's a little less obvious than that, okay? But every wealthy trader I've talked to has explained to me what their edge is in very simple terms, and I got it. And there's something there about that. If you can't explain it to somebody, either figure out how to explain it, because if it's working, then you should be able to, or you don't really have an edge and you're still guessing. So wealthy traders know what their edge is. You've got to know what your edge is in the market. It's the only way you're going to make money in this business long term. All right, 21. The position size is calculated exactly on risk tolerance. This goes back to where they set their stop loss and everything else. Most traders I talk to who are relatively new, and some who are veterans, will say, my position size is 1,000 shares. I trade 1,000 shares on everything I trade. Okay, I suppose that's one way to do it, But the wealthy traders I talk to, they have no position size. If I ask them how much, so when you trade Google, how many shares do you trade? And they'll tell me, well, that's entirely dependent on how much I'm willing to lose. So they do the math. They say, okay, if I'm only risking 2% of my account, and my account is $100,000 or $10,000, and so I can only risk 2%, and the average true range is, $3, then my share, I will trade 33 shares. I mean, they literally work the math backwards to get their share and position size. It's not arbitrary. So you need to start thinking about calculating your position size based on what you're trading, how fast it moves, the true range of that, and your account size. That's really what you need to be calculating. And so instead of saying you always trade 100 shares, come up with a system that calculates position size based on what you're trading. That's what wealthy traders do. 22. Profit targets are based on average true range. I kind of went over that just a second ago. If you are setting profit targets that you say you always want to make 2 points, well, that's fine, but what if the market's not going to give you 2 points normally? It may happen. You may get lucky that day. Or if you would say, oh, I'm going to make 5 points in this, okay, and you're a day trader, but the average true range on this thing is only 3 points, why is it 5 points? Why are you expecting the market to give you more than it normally does anyway? And that's from the very low to the very top, let alone trying to hit those marks exactly. So set profit targets that are within the range of normality of that thing for the day. 23. 1 or 2 trades a month make their month. I was actually surprised by that. I thought really wealthy traders make money every day and they make about the same amount of money every day. Oh, no. They've gotten patient enough that, 1 or 2 great trades a month make their month. Some of them, 1 or 2 great trades a year make their year. Now think about the patience involved in having to go in and out of the market waiting for that 1 or 2 trades a month, let alone a year. That is crazy amount of patience, but they do it because they know if they do that long enough, those 1 or 2 trades will come along where they can really pile on that size. And I hate to say that trading is like gambling, but it's sure a heck of a lot like poker. Because when great poker players have that hand, they see what everybody else has, and they know they got it. Man, they will start piling on those chips into the middle of the table like you will not believe, because they know that that trade has come to them, or that hand has come to them. So in that sense, it's very much like this. And I guess it's no surprise that great traders are often great poker players. So don't worry. You're going to go 3, 4, 5 days, 6 days where you're kind of just droning along. You're making a little money, you're losing a little money, and then bam, you got the great trade. You really pile on some size of that, and that makes your month. That's the way a lot of traders operate. So it's consistent in the sense that they're always in the market and participating, but they don't get those big trades. When they come along, they see it come along, and they really take advantage of it. 24. Confident decision makers in the face of incomplete information. We talked about that already. I think I'm repeating myself on this one. But it's about that comfortable being uncomfortable. You've got to get comfortable making decisions without that complete information, because you're never going to get it. You're never going to know, unless you're doing insider trading and you're going to jail, that you're going to have that great information. You're going to have to make decisions even though you don't have it, and it's not comfortable for us. It's just the way it is. Got to get good at it. Number 25, a little touchy-feely on this one. A losing trade is not a reflection on themselves as a trader. That's why they can take trade number 5 with the same gusto as the 4 losing trades previous, because it doesn't reflect on them. I'm not a bad person, or I'm not an idiot. I'm not a moron because I made a bad trading decision. You're only a moron if you do number 14, which is add to a losing trade. So don't worry about it reflecting badly on you. You're not a bad person. You're not a moron. You're not an idiot. Statistically, it may just happen. And the wealthy traders out there, it just like water off a duck's back. They don't even think about it. They're just on to the next thing. Now, that said, you don't want to get stupid about it. And if the market is telling you that something is different now, you've got to make adjustments. But for the most part, it's not a bad reflection on themselves. It's just the way it is. It's just this business. 26, they buy higher highs and sell lower lows until it turns. I can't tell you how many people are out there trying to find the bottom at 52-week lows and the tops at 52-week highs. You know what the wealthy traders are doing? They're buying 52-week highs and they're selling 52-week lows. Because what? They know that things are more likely to continue in the same direction than they are to turn. Now, if somebody tells them that it's about to turn, they may wait for confirmation, see it turn, and then take some money and put it in the market. But for the most part, they're just doing what is already happening in the markets. So they're buying the higher highs and selling the lower lows. So that goes back to the buying, stop trying to pick those tops and bottoms because it's really a fool's game. Their business isn't trading, it's finding the right trades. What does that mean? That means I may sit in front of my computer and not trade for 6 hours until that trade comes along that meets my criteria, and then I take it. The business isn't in there trying to make trades and actually hitting that execute button as often as possible like it's a slot machine. They're a trader. They know they're a trader even if they sit there all day and never make a trade. They're still a trader. They're looking for the right trades. Your business is not trading itself. Your business is finding the right trades. 28. They write down and record every trade, their price, their thoughts, their mood. This is a trading journal. You should probably keep a trading journal. And a lot of these guys, I actually had the privilege of seeing a guy's trading journal, and it talked about like what he'd watched on TV the night before because it was affecting what he was thinking about, and he was distracted. I mean, it was the weirdest stuff he put in there, but you know what? It helped him develop patterns, and then he realized that, you know what? I'm making all my losing trades, or like 80% of my losing trades between 10 a.m. and 11 a.m. Pacific. So guess what? I'm going to stop trading between 10 a.m. and 11 a.m. Pacific. And I can fight through it all day and try to make those trades and see if I can figure out why. But how about just stop trading during that time? And boom, guess what? 80% of your losing trades are gone because you stopped doing that thing that you realized you were doing only because you took a trading journal and marked all that stuff down. So keep a journal. 29. Their conviction on an active trade remains unless something major changes. I think we beat that with dead horse quite a bit. So unless something changes, continue on with your confidence in your system if you have that edge and you're confident in your edge. All right, number 30, last one. A winning trade does not result in taking on extra risk the next trade. I do this all the time when I play blackjack. It's like the reverse martingale. If I've got a $10 bet and I win and I got $20, I'll let it ride. No, let me let it ride again. No. If your size is $10 at the blackjack table, do not put on $20 because you won the previous hand. If you had a great trade and you met your criteria, you followed your rules, why are you going to double the size the next time out? You are just asking for the market to slap you. So if you have a winning trade, do not take on extra risk on the following trade. Trading should be a relatively boring, over and over again, systematic kind of droning on kind of thing. Really, that's what it should be. We're not here to get excitement and adrenaline. If that's why you're here for the wrong reasons, you'll lose money. So just keep with the status quo. If you're doing well, you'll be rewarded for sticking with it. All right. That is my 30 habits. Let me try and go through some of these questions here. I think I got a lot of them, and if I don't get to all of them, you can always, of course, email me at tim@traiderinterviews.com. There is one thing. This is my one and only. Oh, wait a minute. We have 31. Wow. All right. Bonus one. This is pretty easy. This was quick. They trade the reaction, not the news. So they are trading what happens, how people are reacting to the news, not the news itself. They're certainly not going in before non-farm payrolls, which I think is tomorrow. They're not going in and doing that in anticipation of it. They're waiting for the reaction. Some traders make their entire living on playing the reaction to the overreaction, that first reaction. That's how they make their money. They wait for it to react, which they always know is going to be an overreaction, and then play the other side. Entire trading careers have been made on that. So there's 31. So my only pitch and my 10-second sales pitch to you is that I've interviewed 250 traders and asked them extremely detailed questions about how they do it, and we've put our site on sale at traiderInterviews.com. You can become a lifetime member now for the price that we normally charge for 1 year. That's it. That's my pitch. Let's get to the questions. All right. Let's see. A couple of comments here. Never fix an option trade that is losing money. Okay, good. Yeah, putting on another butterfly to fix your first butterfly rarely works. You're right. Let's distinguish between a losing trade and letting it work. I would say if you're not fiddling with your stop and you're confident that that stop is where you're okay losing that much money and it hasn't hit it yet, then let it go. But what I say is a losing trade is if it hits your stop, don't move your stop because you want to give it a little more time. That is deadly. That has killed more trading accounts than anything else. And I'll be honest with you, I'm not a great trader when I sit and watch my trades. The way that I've found that I make money is I put in a trade because I have an idea. I put in a profit target, I put in a stop loss, and I walk away. I literally walk away. Whatever gets hit, gets hit. Because when I sit there in front of my screen, I start going, you know what? That profit target, this thing can really roll. Let's move this sucker up. Or, you know what? Oh, man, I put this trade in, and it's already heading against me. Ooh, let me move that stop just a tad. No, 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 no. If I put it in and I walk away, I make money. When I sit there and I watch it, I start fiddling with it, and I inevitably screw with myself. So that's just how I trade. It may not be that way. Some guys are good sitting in front of the screen. I haven't developed that discipline yet. So that's what I mean between losing trade and letting it work. Please do not talk so fast. I know. I'm sorry. I just get excited about this stuff. And that's why I'm going to give you the recording so you can listen to it over again. And if you missed something on one of the slides, feel free to email me, and I'll get back to you. Let's see. It looks like my explanation of 17 did okay. I'm getting better at it, so that's good. Liquidity providers are cost averagers. They do add and subtract to positions, winners or losers. Okay. I would say the majority of wealthy traders that I talk to don't add to a losing position. We've already talked about that. They do add to winners, certainly, but they may take away and then put back on before it hits their stop. They can adjust it. That is true. There's some option strategies here, and I don't trade a whole lot of options, so I'll just read it here quick. Sell front month option, buy back month options. You are selling the hot option while protecting your short with a long. Okay. I've heard that. Sell premium when it's expensive, and then buy premium when it's cheap, right? How does it make a difference in trading if one thinks is a market maker? Because the wealthy traders out there feel like they're not just buying and selling. They're providing liquidity to the market. They're providing buying and selling for other traders that are out there, and that's how they make money. They make money taking the opposite side of the 90% of retail traders out there that lose. So if that's necessarily true, then the way to make money is to do the opposite of what most of the retail public is doing. And so that's why they feel like making a market in something is the way to make money. If you plan to layer into a trade, would you consider that adding to a losing trade? I would say as long as it hasn't hit your stop and you feel like you want to add money to it, okay, you know, all right, I can see. No, no, I'm going to say no. You can. I'm trying to see a situation where layering into a losing trade. I mean, unless that's the. See, now you're making me go against number 14, and I just said never ever do it. So I better be careful. But I will. If the plan is always to add in a 5,000 shares, and you've only got your first 1,000 on, and it's gone against you a little bit, then if that's the plan, I guess continue on the plan. But for most of us, I mean, a couple of ticks and it's going against you, and you're going to add to it. It's just dangerous, very, very dangerous. And I think you've got to leave that to the people that either have more information or work at Goldman Sachs and can get to the market a lot faster than us. All right. All right, somebody came in late. They're going to get the recording in about half an hour. Or not half an hour, 3 hours, sorry. Let's see here. What do you see in mix of instruments, variety of single type? I think what you're saying is that can you trade different things? You can, and there are some great traders out there that trade all kinds of markets, but I found that people specialize. They really do. The E-mini is their thing, or the full S&P contract is their thing. That's what they trade. They feel like a participant in that market because they do it every day, and they get a feel for the behavior of that market, so they feel comfortable with it. So certainly there are people out there that when the stock market is kind of lame during lunch hour, they'll switch over to futures. They'll switch to Forex, but they're a minority, I'll tell you that. You know, there are people, most people specialize in one thing and just get really good at it. It's like anything else in life. I mean, most people they're not great at 20 different things in life. They're great at one thing, and they just do it all their life, and they do it over and over again. All right, let's see. Can you give some examples of edge? Yeah, I mean, that's a hard one because it is different. That's where trading really is very individual. For some people, you know, tomorrow's non-farm payrolls, they make all their money on NFP days. And that's because they play the overreaction. They've gotten very good at seeing the market, seeing where that reaction is going to change, understanding that it takes about 5 minutes for that to happen, and then these things happen because they understand the behavior of traders after big economic announcements. And so their edge is playing the reaction to the reaction, if that makes sense. So like I said, it can be as simple as my edge is trading off stocks that come down and hit the 618 Fibonacci line to the tick. It only gives me about 2 trades a month, but when those suckers hit that 618, I am in, and I am in big because it works for me. That's an edge. And so it's different for everybody. It's not always technical analysis. And the hardest traders to talk to are the guys that are just gut feel. Like, they'll tell you, like, so how do you trade? And like, you know, I look at the charts and I just, I know it's time to trade. Those are hard interviews because I know they're big traders. I have friends that are friends of theirs that know this guy, you know, lives in a beach house and works from home and he trades with 6 screens or 1 screen or whatever it be. I know he's a good trader, but he's a gut trader. And those are the hardest ones. And they are out there, but it's pretty rare too. All right, let's see. What's more risky, police or trading? Well, let me tell you something. I say in the video on my homepage of trader interviews that when I was a full-time police officer and I worked the 2 p.m. to 2 a.m. shift on the West Coast in LA, and so I would get up at 6:30 and trade from 6:30 to 1, and the most stressful part of my day was the morning. I didn't care if I chased a guy with a gun down an alley that night. The stressful part of my day was trading. So I think it's all a perspective, I guess. All right, let's see. Email address, one more time, it's tim@traderinterviews.com. And if you go to traderinterviews.com and you fill out the web form, that goes to me too. So it'll go to Emil, my brother, too, but we'll both get it. All right, let's see here. A couple of good presentations. Thank you for that. So I did it today, added to a loser and lost $1,300. Wow. Yeah, see, it'll get you. Now, the key for you tomorrow is to get up and be confident in the trades that you do see, even though you lost that $1,300, and not try to make up for it by trading bigger because you want to make up that $1,300. You're just going to have to make it up slowly and as it comes. Your idea, you're not supposed to make up your loss. You're going to trade your plan, and you'll make it up eventually. But the idea is not to trade to make it up. That always gets you in trouble. All right, let's see. Okay, yeah, people are asking for the slides. I don't give out my slides. I don't email them. I mean, if you watch the video, you can make the slides yourself, but I just don't feel comfortable emailing my actual slides out. Sorry, it's just my thing. So you can see them on the recording, and you can pause the recording and every time and write down every single word on every slide. You're welcome to do that. All right, I think that is about it. I mean, there were a lot of kind of duplicate questions, and again, I'm sorry, there's a huge list of questions here. I think I got through all of them, but some may have come in after I started going down and scrolling down. So if you have a question, feel free to email me. I give away a full free 1-hour interview on my site if you join my email list. I think most of you are on the email list now that you've joined and gotten on the webinar. But if you kind of want to hear a freebie interview, you can get it from the site. That's it for now. Thank you very much. I really appreciate you spending. I know everybody's got busy time, you know, after the holidays and school starting. I've got my daughter's probably going to go help with some homework now. Everybody's busy, so I really appreciate you taking the time to be here with me tonight. That's it. You're welcome to give me a call or an email anytime. Thanks again. I appreciate it, and we'll see you next time.